Good morning, everyone. 12th class, Accountancy, Chapter 8, Dissolution of Partnership Firm, and topic is Realization Account, Preparation of Realization Account. Realization Account. So, as you all know that preparation of any account is a part of ledger. So, before doing ledger, we must know the journal entries. So first we will be doing the journal entries. What journal entries will be passed at the time of realization account? So first of all, you must know what is realization account. So as I told you earlier that at the time of dissolution of the firm, all the assets are sold off. All assets are sold. Liabilities are paid. And for selling of asset and for making payment to liabilities, realization account is prepared. It means we will be selling all the assets through realization account and we will be making payment to all the liabilities through realization account, and there must be a profit or loss in the realization account. That profit or loss will be transferred to partners capital in their profit sharing ratio. If the capitals are fixed, then that profit or loss will be transferred to partners current account. So realization account is an account which is prepared at the time of dissolution of firm for selling of asset. Selling of asset means for realizing assets and to pay off all the liabilities. Then after making payment to all the liabilities, if anything is left, it may be profit or loss, then that is shared among the partners in their profit sharing ratio. So before knowing much about the realization account, you should know two, three things. That first of all, we need to sell the assets. For selling of the assets, we need to transfer all the assets in the realization account. So assets, all the assets have debit balance. We are going to close the asset account. Okay, all the assets have debit balance. We need to close the asset account. So to close the asset account, what the asset will be, debited or credited? Tell me, what the asset will be, debited or credited? Transfer of assets. So all the assets will be credited, and what will be the other account? Realization. So in every question, the first entry will be this: realization account debit to all assets. To all assets and at their book value. Book value means the value which is given in the balance sheet. Except, all assets will be transferred except cash, bank, and all the fictitious asset. Fictitious asset like advertisement suspense account, deferred revenue expenditure account. These will not be transferred. Debit balance of profit and loss account. All these are the fictitious assets. So we will be transferring all the assets by passing this entry: realization account debit to all assets at their book value. Book value means the value which is given in the balance sheet. And which assets will not be transferred? So it is a one marker question. Which assets will not be transferred in the realization account, or which assets will never be transferred in the realization account? So the answer is cash, cash in hand, cash at bank, and any fictitious asset if it is given. Examples of fictitious asset are deferred revenue expenditure like advertisement expenditure, advertisement suspense account, and the second is debit balance of profit and loss account. Debit balance of profit and loss. So these are the three examples which will never be transferred to realization account. Okay. So what about the goodwill? Sometime in the balance sheet, goodwill is also given. So goodwill will be transferred. All assets here I am mentioning, including goodwill. So before this chapter, if any goodwill was given in the balance sheet, that was the existing goodwill, and we used to write off it by passing the entry partners capital account debit to goodwill. But this is the one difference. Now you will see many differences. So first difference is this, that in other chapters of partnership, existing goodwill was always written off. But here, the goodwill will be never written off. Goodwill will be treated just like any other asset. So along with all the assets, goodwill will be transferred to realization account. So first entry will be realization account debit to all assets, including goodwill, but except cash, bank, and fictitious assets. And all the assets will be transferred always at their book value only. Market value may be different from the book value. Book value means the value which is given in the books. Books means balance sheet. Here the book means balance sheet, and the market value means the value which we will be getting from the market when we will be selling that particular asset. Okay, so two values of each asset will be given in the question, book value and the market value. So first entry will be passed with the book value, not the market value. Okay. So transfer of asset, realization account debit to assets, all the assets individually we will be writing, like realization account debit to land, to building, to plant, to machinery, to furniture, to stock, to debtors, all the assets, whether it is current asset or non-current assets. Here you can see that the book value is written. So make sure you are transferring the asset only at the book value. Then sundry debtors are transferred. So one or two more things are here which you need to know, that debtors will be transferred before deducting the provision. Like this is the balance sheet. And in this balance sheet, this is asset side only. I'm here making the asset side. So debtors are given. Debtors 80,000 less provision 5,000. And in the outer column 75,000 is written. So debtors will be transferred at 80,000, not at 75,000. So debtor is an asset and provision is a liability. So we cannot show the net effect. Why? Because if we are showing the net effect, then the provision account will remain opened. It's time to close down the accounts. So no account will remain open. All the accounts will be closed down. So we need to close the provision account. Okay, so debtors will be always transferred at their book value, which is 80,000. Suppose here in this example 80,000, and provision will be treated just like any other liability. In 11th also we have also studied that provision is a liability, internal liability. There are two types of liability, internal and external. So provision we need not to pay to any outsider, but it's a liability. So it's need to be closed down. So debtors will be transferred before deducting the provision amount. Second thing, goodwill appearing in the balance sheet is also transferred to the debit of realization account at the book value. Okay, so including goodwill. So in first entry, what points you have to keep in mind? First, all the assets will be transferred except cash, bank, and fictitious assets. Second point, including goodwill. Goodwill will be also transferred at its book value. Third point, debtors will be transferred before deducting the provision amount. Okay, debtors will be transferred before deducting the provision amount. So in this manner, all the asset account will be closed because assets were debit and we have credited it. So all the assets accounts are closed and all the assets have reached to realization account. Next, treatment for liabilities. Like you can see in this example, we can see one example for better understanding. Shreya and Brinda are partners who share profits in the ratio of 3:2. Following is the balance sheet. The firm was dissolved on that date. So you need to just transfer the assets. So assets will be transferred by passing the journal entry realization account debit to stock. Cash will not be transferred to stock 7,500, to sundry debtors 21,500, to fixed assets 36,500. P&L will never be transferred because it's a fictitious asset, and provisions will be transferred just like the liability. So this will be the entry. Realization account debit to stock, to sundry debtors, to fixed assets, sundry debtors before deducting the provision. So the narration will be for transfer of assets. That's it. For transfer of assets to realization account. Next, for transferring of liabilities. Next, all the liabilities will be transferred other than, so all the external liabilities will be transferred. You can learn like this, all the external liabilities will be transferred. External liabilities. External means which are payable to outsider. For example, bank loan, partner's relative loan, not the partner loan, partner's relative loan, creditors, outstanding expenses, BP, income received in advance. All these are of external liability. Provident fund, if the firm is maintaining any PF, provident fund, that also needs to be paid off. So provident fund, all these are the external liability. You can see that I have not written partner loan. I have written partner's relative loan. Why? Because partner loan will be given second preference. So first we are making the realization account just to make the payment to external liabilities only. Okay. So partner loan will never be transferred to realization account, not the partner's capital. For them, we will be making a separate account. For partner loan, separate account will be prepared. For partner's capital, separate account will be prepared. So this account is prepared only to pay off the external liabilities. Along with all these, provision for doubtful debt will also be transferred. Provision for doubtful debts will also be transferred because it is an liability. It is a liability, but we need not to pay it. Okay, so it will be also transferred and its account will be closed. So when we will be transferring all these things, all these are in the liability side of the balance sheet. It means all these have credit balance. So all these are credited. So we need to close this account. So entry will be, if we need to close any account, then it is reversed. If it is credited, it is debited. And if it is debited, it will be credited. So the journal entry will be all the liabilities have credit balance. Here we are going to close it down. Okay. So when we will be closing it down, then all the liabilities will be debited. So the journal entry will be external liabilities account debit to realization. For assets, we have passed the reversed entry realization to asset. But here for liabilities, we are passing the entry external liabilities. Please attention and pay attention to this external word. Otherwise, you may transfer partner loan or any other liability. External means the amount which is payable to outsider. Only that liability will be transferred, including provisions, provision for doubtful debts, provision for discount, that will also be transferred. So again, the liabilities will be also transferred at book value. Now we have closed down the balance sheet completely. All the assets are transferred, all the liabilities are transferred. Next, bank overdraft is also transferred to the credit of realization. Cash and bank balance are not transferred, but bank overdraft is also transferred. Why? Because bank overdraft is also an external liability. At the time of closing of the business, you need to pay the excess amount withdrawn from bank to bank. Okay, so bank overdraft will also be transferred. So this is the again one question. Now you need to transfer the liabilities only. Okay, only the liabilities will be transferred. Following is the balance sheet. Assets we have already transferred. So in this question, you can pass two entries. First entry for the transfer of asset, second entry for the transfer of liabilities. So how the entries will be passed? First time transferring all the assets. Then what journal entry will be passed for transferring assets? Realization account debit to which assets will not be transferred? Bank will not be transferred. Then P&L account will not be transferred. Okay, so to stock, to investment, to debtors, all the assets will be transferred individually to fixed assets. Okay, amount is stock 70,000, stock 70,000, investment 1 lakh, debtors 2 lakh before deducting provision, and then fixed assets 380. Now do the total. 2 lakh 380, 580, 680, 680 plus 70, 750. 750, 120, 120 or no, sorry, 3 lakh 580 580 680 680 plus 70 750. Being assets realized. Being assets transferred, sorry, not realized. First entry is done. Second entry, transfer all the liabilities. So creditors, account debit, Mrs. A's loan. I can consider Mrs. A's loan. Why? Because A is partner and Mrs. A is an outsider for the business. It's not the partner loan. It is his relative's loan. Mrs. A's loan. Debit. Then B's loan. B's loan will not be transferred. Why? Because B's loan is a partner loan. So it's not a third party loan. Then provision. Provision for doubtful debts. It's 20,000. Creditors 360. Mrs. A's loan 60. And provision 20,000. Then one more thing I just want to tell you here, that in previous chapters we have learned that if IFF investment fluctuation fund or IFR is given, then it is always distributed among the partners in their profit sharing ratio. But here the rule changes. What is the new rule for IFF? That IFF is prepared or made to meet out any fluctuations in the investment value. So now we are going to sell off it. Okay, so when the investment will be sold off, there may be profit or there may be loss. So if the IFF is given along with investment in the question, then investment will be transferred with the assets and IFF will be transferred with the liabilities. No distribution. You can note this point, no distribution of IFF if IFF is given along with investment. But if IFF is given in the question, but investments are not given, then IFF will be distributed. So there are two conditions in relation to IFF. IFF is given along with investment, IFF and investment, both are given. Then it will be transferred, it will be also transferred. Both will be transferred to realization account. If only IFF is given, no investment, then distribute. Okay. If investment are given, then it will not be distributed. If not given, then it will be distributed. So here IFF is given along with investment. So it will be transferred 30,000. Now to realization account. Clear? So whatever is the total, 30 plus 20, 50, 50 plus 60, 110, 110 or 470. So all the liabilities are transferred in this manner. I hope I am clear till here. Please tell me so that I can proceed for the next journal entries. Till now, I have just explained two journal entries. First, all the assets will be transferred. Second, all the liabilities will be transferred. Yes, please tell me, am I clear till here? All the assets are transferred, including goodwill, except bank balance, cash, and fictitious asset. Then all the liabilities will be transferred, including IFF, if investments are given. Please tell me, students, if I am clear, I can proceed. Yes. Next. Now the assets are transferred and liabilities are also transferred. Now we will do the main thing. What is the main thing? Selling of assets. Sale of assets. So whenever we will be selling the assets, then we will be getting the cash or bank. Okay, so whenever firm is getting cash or bank, then bank balance is increasing. So bank will be debited. At the time of sale of asset, the entry will be bank / cash account debit. 2, the whole money will be coming only in realization account. Okay, you cannot write like you have sold furniture. So you cannot write here bank to furniture. The entry will be wrong. Why? Because furniture is already transferred to realization account. Furniture account is already closed. So all money will be coming only in realization account. So whatever the journal entry we will be passing here, always one account will be realization account at the time of transfer, at the time of sale, at the time of transfer of liabilities, at the time of making payment. So this entry will be passed for selling of all the assets. Suppose you have sold furniture, you were having a furniture. So at the time of transferring of furniture, you must have done this entry, realization to furniture, 50,000. Now suppose you have sold this furniture. So the entry will be bank account debit, not to furniture. Why? Because furniture account is already closed. So the entry will be bank account debit to realization. And which value should come here? Market value or book value? Please tell me. Which value should come in sale of asset entry? Market value or book value? Please tell me. Yes. Yes. Book value should come. When we are selling the asset, then how you can write the book value? Selling price can be different from book value. It can be more, it can be less. So when you are selling the asset, book value will never come. So what will come? Market value. Market value means the sale price at which we have sold off the asset. It may be more than the book value, it may be less than the book value. So suppose we have sold the furniture for 45,000. So this entry will be passed. This entry at the time of transfer, this entry at the time of sale. So all the assets will be sold off individually. So bank account, cash account debit to realization at market value, not at book value. So this entry will be passed for selling of all the assets. You can see land and building book value rupees 160 sold for 3 lakh. Book value 160. So at the time of sale, consider this thing, book value will never be considered. Market value will be considered. So the land and building book value 160 sold for 3 lakh. Okay, through a broker who charged 2% commission on the deal. So you have sold this asset for rupees 3 lakh through a broker. So broker will be charging. So here you need to show the net amount the firm has received. Okay, net amount the firm has received. So you will be not considering the book value here. You will be just considering the market price, 3 lakh, and you have paid 2% commission on the deal. So whenever there is a deal and you are making payment of commission, then commission will be calculated not on the book value, at the deal price, because he will be charging his commission at the price for which he is make a deal. Okay, so commission will be charged on 3 lakh, 2% commission. So 2% commission of 3 lakh is 6,000. So if we are receiving 3 lakh by sale of asset, then we need to pay 6,000 to broker. So we can directly write the net amount. So the entry will be bank account debit. First entry will be transfer of the asset. So transfer of the asset, I am not passing the entry again and again. So here I am just showing you how the asset will be realized. So bank account debit to realization account. You cannot write to land and building. Okay, to realization account. And what is the net amount? 3 lakh we have received. Out of this 3 lakh, 6,000 we have paid to the broker. So the net amount here is 2,94,000. Being asset sold, yeah, land sold. That's it. Next, one more example we can do. That is the debtors amounting rupees 1,40,000 were handed over to a debt collection agency. Debt collection agency means they will be collecting your amount on your behalf. You need not to go to the debtors. They will be going to the debtors and they will be doing the collection on your behalf. But of course, they will be not doing this service free of cost. Okay, so they will be charging their commissions to a debt collection agency which charged 5% commission. So for collecting this debtor amount, they have charged 5% commission. The remaining debtors were 47,000, out of which debtors of 17,000 could not be recovered because the same became insolvent. The journal entry will be, now you need to calculate the amount. 1,40,000 were handed over to the debt collection agency which charged 5% commission. So 1,40,000 commission you need to charge. Then the same entry will be passed, bank account debit to realization account. The net amount you need to show. Okay, so calculations you can do by your own. The furniture of rupees 70,000 was sold for 68,000. So it was of 70,000, but you need not to consider the book value here. So it was sold for 68. So the Bank price will be 68,000, but you have also given a commission to rupees 2,000 to the auctioneer. So the net amount here will be 66,000. Am I clear? Wait a minute. Asset is taken over by partner. If asset is taken over by partner, like if a firm is having any asset like car or any other asset, and partner is saying that I will take over that asset, I am ready to take up that particular asset. So in that case, if the asset is sold, this entry will be passed bank account debit to realization. This entry will be passed. But if asset is taken over by partner, it means partner need to make payment to firm. Okay, partner needs to make payment to firm. So whenever partner is to get any amount from firm or partner is to make payment any amount to firm, then in that case cash will not be involved. Partner's capital is there. So all the entries in relation to making payment to firm or getting payment from firm will be passed through partner's capital account, and final settlement to the partner will be made in his capital account. Okay, finally his capital account will be paid. So when the partner is taking up any asset, then he needs to make payment to firm through capital account, so his capital account will be reduced, and whenever capital account is reduced, it is always debited. So partners capital account debit to partners capital account debit to realization. So you can see here, if the asset is sold, bank is debited. If the asset is taken up by partner, then partners capital account is debited. No effect on credit. In both the entries, realization account will be credited, and this entry will be passed at the market value. Suppose the firm is having a vehicle costing rupees, book value is having 2 lakh, but the market value of this vehicle is 1,50,000. So this entry will be passed with 1,50,000. Clear? Stock worth rupees 7,500 is taken by a partner Rohit at rupees 7,000. So there is a stock whose costing is 7,500, but it is taken by a partner. Partner name is Rohit. So make sure the stock is already transferred to realization account. First of all the assets will be transferred. So we have assumed here that the stock is already transferred to realization account. Now we are just passing the entry for its treatment. So that stock is taken by a partner Rohit at rupees 7,000. So the entry will be, partner name is Rohit. So the entry will be here, Rohit's capital account debit or R's capital account debit to realization. If the capitals are fixed, then capital account will be written as current account. So R's current account debit to realization account. And what was the amount of stock will not be considered here. This amount will be considered when we will be transferring the stock to the realization. Now the amount at which the deal was there, that is the market price, will be considered. So this stock is taken at rupees 7,000. Clear? Next, payment of liabilities. So payment of liabilities, how the liabilities will be paid. So in asset realization of assets, we pass the entry realization of assets, we pass this entry bank to realization. Why this entry? Because we were getting the bank balance, we were selling off the assets, so we were getting the bank balance. Now this bank balance will be used to pay off the liabilities, so of course the entry will be reversed. So payment of liabilities, the entry will be realization account debit to bank. So liabilities can be paid more or less. So whatever the amount we are paying, that will be written here. Paid value, not the actual value. The amount which we are paying will be written here. Like there were creditors of rupees 80,000, but some creditors were untraceable. They did not appear to claim their money. So 10% of the creditors were untraceable. So out of 80,000, 10% creditors untraceable means need not to pay. So we will be passing this entry only with 72,000. It means this entry will be passed only with the actual amount which we are making payment. Okay. So Realization account debit to cash or to bank. This entry will be passed at the time of making of liability. So in short, till now I have told you 4 entries. I am writing here again for a better recap or revision. So first is the transfer of asset, realization to all assets. Which value? Book value. And which assets will not be transferred? Cash, bank, and fictitious asset. Then transfer of all the liabilities. Liabilities only external, not the internal. To realization. Again, which value? Book value, including all provisions. Then assets are sold off. Entry will be bank account debit to realization at their market value. Then liabilities are paid off, realization to bank. You can relate the entry. Okay, realization to asset, bank to realization, liability to realization, realization to bank. This at the time of transfer and this at the time of settlement. Liabilities are paid and assets are sold. These are sold and liabilities are paid. And at the agreed price, this entry will be done at the agreed price. It may be more than the book value or it may be less than the book value. Bank loan of rupees 3 lakh was paid along with interest of 21,000. The journal entry will be bank loan of 3 lakh along with interest. So you need to pay actually 3 lakh 21,000. So the journal entry will be realization to bank, not the bank loan to bank. So make sure you are not debiting the liability. The realization account will be debited or credited at the time of settlement of the liability. Here. So next, please do this question. Sundry creditors amounting to rupees 36,000 which were payable after 2 months were settled at a discount of 10% per annum. So in these type of questions, there must be a discount. We were supposed to pay creditors after 2 months, but if we are paying it right now, if we are making payment before time, then we are subject to get the discount. Always there will be a concept of discount. So make sure the per annum word is here for discount for the with the rate. If per annum is here, then we need to consider the time period. Time period is 2 months. If per annum is not here, then need not to consider the time period. Directly 36,000 into 10%. So here we need to make the payment. How the payment will be made? Realization to bank. Realization to bank. Now how the amount will be calculated? 36,000 and the rate of discount is 10% and the time 2 months. If per annum is not there with rate, then don't consider this time. 600 rupees is the discount. So we will be getting 600 rupees discount out of 3600. 600 is discount. So we need to pay. Whatever the journal entries I'm telling you here, all this will be the part of the full-fledged question. These type of journal entries will be there. Okay, so if you are doing here, then there will be no problem in doing the full-fledged question. Clear? Next, do this question yourself, do all the calculations. I am waiting for your answer.